Bansal from Vinod Kothari and Company. Welcome to our Thorough with 30 series again. We are back with this episode where we are discussing particularly about freshly introduced quantitative threshold for Regulation 30 disclosures. So before I get onto the actual mudda, I would first take you through a little of the background. So when we talk about the context, we are aware that SEBI has classified the events requiring disclosure into three broad categories. So first category is deemed material event, where we all understand there is no need to apply any sort of criteria or test. We simply go to the para A of part A of schedule 3. We see if the event or information is falling under that category and we call it material if the information or event falls in that para. Now, second category is event or information which require some sort of assessment. So those all items are contained in para B. Although there are list of items in para B, we have to check whether such items are in fact material. For that, SEBI has given certain perspectives. Now, the third category is, of course, the residual category, which does not fall under para A or para B, but which can still be material for the entity. Now, for today, we are particularly dealing with the second category of events. That is where we require some test to determine if the event is material or not. Now, before the SEBI second amendment regulations 2023 came in, the test was completely subjective. Basically, what I have to see is whether the information or event which I am thinking about can possibly trigger some sort of significant market reaction, or it can possibly alter or discontinue the information which is otherwise already available to the public. There was no numerical test as such. But what SEBI has done is, after, we can see the discussions in the consultation paper. I'm not going into the details, but what SEBI has done is to come up with a quantitative threshold. This is in addition to the qualitative threshold. Basically, the assessment has to be done on both the fronts, qualitative as well as quantitative. If any of these criteria are hit, the event becomes material. Now, what this quantitative criteria is, I'll just show you on screen. Yes, here it is. So SEBI says the omission of an event or information whose value or the expected impact in terms of value exceeds lower of the following. Now, SEBI has gone on to prescribe three variables: 2% of turnover, 2% of net worth, and 5% of average of absolute value of profits or loss after tax. So basically, these are the three yardsticks. We will compute these three variables and we'll pick the least of these, and that least value becomes the threshold against which we will compare the value or the expected impact in terms of value. Now, so basically, there are three steps of assessing whether an information is material or not. So number one, we calculate the quantitative threshold, which, as I discussed, there are three variables: turnover, net worth, and absolute value of average profits. Number three is we assess the value or expected impact in terms of value. And then we compare the value or expected impact in terms of value against the threshold. If the value or EIV is greater than the quantitative threshold, the event becomes, in fact, material. Now, in this step two is quite a critical step in the entire assessment, because it asks you to assess the value and expected impact in terms of value. So when it comes to value, the task may be straightforward in many cases. For example, take the case of litigation. The claim or the counterclaim by the parties can be the value. In case of a penalty order, the amount of penalty becomes the value. But this value may not be available in all sorts of cases. There we have to compute the expected impact in terms of value. Now, what is it? What is exactly the EIV? So when we are saying EIV, we are actually commenting on, or we are assessing the possible impact which the event can have on the listed entity. Now, this impact can be on turnover, can be on profits, or can be on net worth. Now, if I ask you, what would you choose? What would you, what is that something on which you would compute the impact on? What would it be? Will it be turnover? Will it be profits? Or will it be net worth? See, the choice we make, the choice we are making here would be relevant and important, because on that very basis, we will determine if the event is material or not. And of course, that will also impact your impact the market, in fact. So to understand what we are trying to say, we have taken two examples here. I'll just take you through the examples. So there are two examples here. Say, suppose the company is going forward for some sort of capacity addition. In case of example 1, the estimated turnover is 10,000 crores. In example 2, it's also 10,000 crores. But estimated profits in example 1 is 1,000 crores. And in example 2, it is 500 crores. Now, when it comes to quantitative threshold, say 2% of turnover comes out to 1,600 crores, and 5% of average absolute profits comes out to 800 crores. Therefore, 800 crores becomes our quantitative threshold. Now, how will I determine materiality in this case, and what would be the possible impact on market? Now, coming to example 1, if we see estimated profits, which is 1,000 crores, it is higher than the absolute profits of 800 crores. Sorry. So when we compare this estimated profit of 1,000 crores, it is greater than the threshold of 800 crores. So therefore, the event is material. Even if we compare, say, turnover, 10,000 crores against this threshold, that is also greater than the threshold, and therefore the event is actually material. Now, coming to example 2, say we take expected impact in terms of value as this value, 10,000 crores. So EIV becomes 10,000 crores, and the threshold is 800 crores. Now, this comparison in itself, we are comparing a turnover figure against the profit figure of 800 crores, right? So this is bound to give a very positive result, as in this is bound to say that the event is in fact material. But when it comes to the profits, the estimated profits are only 500 crores against a turnover of 10,000 crores. Now, when we compare this estimated profit against my threshold, does a transaction or does the event look like a material event? Possibly not. So say, suppose going by the assumption that we take turnover as the expected impact in terms of value, the transaction may appear to be material, and we go and disclose that, the market perception would generally be positive as regards this capacity addition. Although in real terms, there is no substantial value addition, because we see that the profits are only 500 crores. As against, what profit is material for the company? It is 800 crores of profits. However, the capacity addition is only giving me 500 crores. So therefore, we might end up giving some incomplete or say incorrect information to the market in such cases. So that's what we are trying to say here, is that in most of the cases, expected impact in terms of value, as far as possible, would be impact on profits of the listed company, because of two broad reasons, I would say. Number one, see, investors are always inclined to look at profits rather than any other figure. Number two, if we check the quantitative thresholds, the three parameters, it would be interesting to see that in most of the cases, majority of the cases, the profit figure would of course be the lowest figure. So if the denominator is a profit figure, then the numerator should also be a profit figure. It would always be absurd and may not be right to compare, one sort of parameter in the denominator and other parameter in the numerator. So we are saying if in the denominator we are taking profits, in the numerator also we should take profits. Therefore, ideally the EIV should be profits only. So in such cases, maybe the listed entity has to take a conscious call